For the last 2 years, we've been writing in our Bennett Jones semi-annual economic outlook about the bumpy road of recovery from the Great Recession of 2008, 2009. Well, we're kind of coming to the end of that bumpy road of recovery, and we're now looking forward to the post-recovery world. What's that world going to look like? And so that's our focus this year. In this spring, we're really focusing on the rest of 2014, 2015, and 16, and asking ourselves, how is the world likely to evolve, number one, over that period? How does that affect us here in Canada, and hence the evolution of our own economy? And then what are the challenges that we have to get through over these next couple of years? As businesses, what are our challenges? And what are the policy challenges for government? So over the last couple of years, we've had reasonably strong developing economies, really very weak economies in the advanced world. Perhaps the developing world, the emerging markets, are not going to grow quite as quickly. We certainly see slower growth in China than the 7.5% to 8.5% we've seen for the last 3 years. We're looking at something more like 7 or 7 and shading down to 6 as we get into 2016. Europe remains slow, but better than it has been. By comparison to negative growth in 2012-13, we're going to certainly see positive growth this year, and that will carry on, but relatively modest. Where the real change is going to come is going to be in the United States. As we look forward now through the next 3 years, we see the government, in particular the federal government, being much more balanced. They're going to still be a degree of fiscal drag, but not nearly what we saw before. States, once again, are beginning to spend in the United States. And consumer balance sheets are very much better than they were a couple of years ago. And so consumers are coming back. And so what we're looking for then in the United States, despite an extraordinarily weak first quarter, we are looking for growth in the order of 2.5% this year, maybe getting much closer to 3.5% next year, and then settling in at something at 3 or a little less than 3 as we get through 2016. Now that's really important because the United States is our biggest customer, and as we have a recovery in the United States, that's enormously important for Canadian producers, whether we're producing automobiles for the American consumer, whether we're producing lumber to build single-family houses in the United States, or whether we're producing oil or raw materials, which we will sell in the United States. So one would think then, with really very much better performance in the United States over the next 2.5 years or so, that should reflect and produce very much better performance here in Canada. Having said that, our view is that in fact, we're going to continue in Canada with growth in the order of 2% this year, next year, and the following year. Obviously, it'll bounce around a little bit, but actually very modest growth. And then the question is why? Clearly, the western part of the country is going to grow faster than the eastern part as resource prices remain relatively elevated, maybe not quite as high as they were at one point, but nevertheless relatively elevated. And the terms of trade for the western provinces are very favorable. In the east, we have much more severe competition, and it does mean that we're going to have to fight harder in the east to make yards in terms of productivity in order to compete. we're in a standard go-forward mode. And what's holding us back? Well, first of all, as a society, we're getting older. Labor force participation is dropping as the average age as society ages and as the baby boomers begin to retire from the labor force. But secondly, and most importantly, we actually remain in many industries relatively uncompetitive relative to the United States or Mexico. So take our NAFTA region as a whole. What we can see is that Canadian costs of producing a unit of output, whether that be an automobile or a barrel of oil, Canadian costs are well above those that exist elsewhere. Our productivity gains in Canada have been way less than the productivity gains that have taken place in the United States or in the manufacturing industry in Mexico. And so we're losing market share in the United States, our biggest market. We're losing market share so that even though they're recovering, their market is recovering, our share of that market has been going down, and we don't have the capital in place to be able to produce more things to meet that demand in the United States. We're going to grow more slowly than the United States grows over the next 2.5 years or so. It's not going to be terrible, but it is going to be slower. So that's Canada as a whole. The question then is, what about the different regions of Canada? So our challenge then in Canada over the next couple of years is really to get our productivity up. And how do we do that? Large businesses and in our small businesses, that we actually make an effort to increase the productivity of our labor and our capital so that we can actually get the unit costs of production down and compete better with the Americans. And that is the real challenge we have. And so you then have to ask the question. The next question is, and this is a much more difficult one to answer, are there things that we could be doing in terms of policy, government policy, improve that outlook for productivity, and hence improve our economic growth over this period? One of the things that holds us back at the moment is infrastructure, our ability to get goods to market, whether that's through pipelines, whether that's a bridge across the Detroit River. We have problems in that regard, and we really do need to get on and build that infrastructure. So actually, this would be a very good time for governments or public-private enterprises or private enterprise to be investing in that infrastructure, that long-lived infrastructure. A good thing now because men and material are available to make the investment, but also really good because interest rates are low, and we certainly forecast them to remain low over this next 2.5 years. And so if governments or businesses can borrow at 1% real interest rates, or even less, then that's a signal that this is a good time to make the investments. And that is indeed will help our overall productivity by getting rid of some of these infrastructure bottlenecks. And obviously it'll help our productivity if corporations invest in machinery and equipment. The likelihood over this period is that Canadian dollar will trade in the range of 90 cents, plus or minus. That gives some help compared to the last few years where it was trading closer to par. but nevertheless, our costs still remain considerably higher than the United States. And so the other part of policy that government can adopt to try to improve the skill level of the labor force through education, but also through encouraging mobility. And then finally, and extraordinarily important, is that Canada continue to seize trade opportunities abroad, to make NAFTA work better, to complete the work on trade arrangements with Europe, and to engage in more liberal trade arrangements across the Pacific. So we need access to markets, and that trade effort will be very important. Not just to get the agreements, where we've been rather slow so far, but then to implement the agreements so that our manufacturers, our resource producers, our service producers actually have access to the markets that will allow Canada to grow. In order to have the funds for all this investment, of course, we need to save more. And that is, we need incentives and encouragement for households to increase their savings. That means we're going to have to make some effort in terms of pension reform, both to encourage employers and employees to voluntarily set aside more money. But I think in the end, we may really have to look very hard at expanding somewhat the CPP to provide A, more savings in the short run to facilitate growth, but B, and most importantly, that people have the income in retirement 20, 30, and 40 years from now that they will need.